Hello everyone, welcome back to the channel. There's a common saying that a penny received today is worth more than a penny received tomorrow. Or you can also say that if you had won $500 of lottery 50 years ago, you would have been richer than if you had received the same amount yesterday. So, this is a general rule which reflects the power of accumulated interest. Similarly, to evaluate the profitability of investment projects which generate cash flows in the future, we use the net present value to calculate the present value of those future cash flows. So, what is the net present value? Net present value is the net cash input that an investment or a project generates in today's dollars, considering the value of money over time. So, what the net present value does is that it converts future cash flows into what their value is today, and then it subtracts the initial investment from that present value of future cash flows to arrive at the net present value. So, we can say that net present value is equal to present value of future cash flows minus the initial investment which we are making at the start of any project. So here is an example of how we can calculate net present value in Microsoft Excel. We have various figures here. We have the weighted average cost of capital, which is the discount rate. It is 10%. And we have various cash flows where the company is starting a project. Suppose it is starting to establish a new factory, and it has to incur an initial cash outlay of rupees 2,50,000. Then this is the initial cash outlay. Then in the next 5 years it will get the income from that project. In the year 1, that is in the next year 2026, it will get an income of 1 lakh. Then in the next year it will get 1,50,000 as the income or cash inflow. Then 2 lakh. Then in the next year 2,50,000, and in the next year 3 lakh. So this is the initial cash outlay, and these are the cash flows over a period of 5 years, cash inflows. So now we have to calculate the net present value. How do we calculate the net present value? We simply will use the NPV function equal to NPV. Then we will input the rate, which is the discount rate. We also can say that it is the weighted average cost of capital. So this is the discount rate. Then the next argument is the values. An important thing to remember here is that initial cash outlay doesn't form the part of NPV function. The NPV function also only takes the future cash flows into account, and if you have an initial cash outlay or an initial cash inflow that occurs in at the start of year, at the start of the present year, we have to adjust that value after we get our NPV result for the future cash flows. I will show you how we can do that later. So we have to input values for the NPV function. So these are the values, cash inflows over a period of next 5 years. So these are the future cash flows. We only have to input future cash flows in the NPV function. We will close the parenthesis here and hit enter on the keyboard. So now we have this value 7,22,168 as the present value for these cash flows. Now so we have to input this value here, NPV result. So now what is the NPV formula? I will show you how we can display the formula in this cell. The function to display a formula for a value, a formula in a cell, is formula text, and then we give the reference. Since our formula is in cell B12, So we will refer to cell B12, formula text cell B12. So this is the formula to calculate the net present value of future cash flows. Now our initial outlay is this 2,50,000. It's a negative value. Now we have to calculate the net present value. To calculate net present value, we will add this value to the net present value. Since it's a negative value, it will automatically get deducted from the net present value result. So our net present value is 4,72,168. So having understood how easy it is to calculate the net present value in Microsoft Excel, there is a word of caution here. The word of caution is that the net present value function assumes that cash flows are happening at the end of each time period. That means this 1 lakh rupees, it is assumed by this NPV function that it is happening at the end of year 2026. Similarly, this 1,50,000 is happening at the end of year 2027. But this is an unrealistic assumption, since in practical scenarios cash flows can happen anytime in the year. It can be at the beginning of the year, at the mid of the year, or on any other date. So to be realistic about the timing of these cash flows, we have one more function in Microsoft Excel, that is the XNPV function. So in XNPV function, we input cash flows. We also input the dates on which these cash flows are happening, so that we can get a realistic estimate about the present value on the basis of the date on which the cash flows are happening in the future. So now let's come to the XNPV function. Here, in addition to the cash flows, we have one more column here, date of cash flows, the exact date on which cash flows are happening. So how do we calculate the NPV using the XNPV function? We use this function XNPV. Then we have to input the rate. This is as usual the way we did it in NPV function. This is the discount rate or weighted average cost of capital. Then we have the values. Here in the values argument, we will input all these values, including the initial cash flow. Remember that in the NPV function, we adjusted the initial investment later on when we had the result of the NPV function. Then we subtracted the initial investment from that value. But here in the XNPV function, we will input all these values, including the initial investment, in the function itself. Then the next argument is the dates. You simply have to input all the dates on which these cash flows are happening, then close the parenthesis, hit enter. So here you have the XNPV function. So now let us display the this is the result. This should be here. Now let us display the XNPV formula. So to display the formula, we will use the formula text function, and we will refer to the cell in which we have the formula. This is the cell B12. So this is the formula for XNPV. We have the discount rate B2, then we have these values C4 through C9, these values, and then we have these cash flows D4 through the D9. So this is how you calculate the net present value using the XNPV function in Microsoft Excel. Now at the end of this video, let's compare the results of the NPV function and the XNPV function. Remember, our cash flows are the same. We have the same initial cash outlay and all cash flows are same, just the functions are different. And in XNPV function, we are inputting the dates. So let us check the result of NPV. It is 4,72,168, and for XNPV it is 4,91,493, which is the present value. So why is this much of difference there? The reason is that the NPV function undervalues our investments, because it assumes that cash flows are happening at the end of the period, whereas in the XNPV function we input the exact dates. For example, in the here in the year 2026, our cash flows is happening on 5th of Feb 2026 and not on 31st December 2026. That means we will get a return on this cash inflow from this date, that is from March up to December. We will get some return. We can invest the cash flow somewhere else and get a return from there. Similarly, in the year 2026, our cash flows is happening on 27th June 2027 and not on 31st December 2027. And here again, we can invest this 1,50,000 at this rate, that is the weighted average cost of capital or the discount rate. We can invest it for these 6 months from July up to December and get a return on that amount. Same goes for this year, 2028, and for other years as well. So this is the reason we have a more realistic estimate about the present value using the XNPV function instead of the NPV function. So that is the end of this video. I hope it was helpful. If you like the video, please give it a thumbs up. Keep supporting, subscribe the channel. Thanks for watching, and I will see you in the next video.